Let's be real about trading. Most of the time, it's just a bet, right? You're betting the market goes up or you're betting it goes down. But what if you could put on a trade where you've basically already won, right from the get-go? Today, we're going to break down this really cool strategy called the Silver Arbitrage that tries to do exactly that.
I mean, come on, we've all been there, right? Staring at the charts, heart pounding. Should I buy? Should I sell? Oh man, what if silver skyrockets? Or what if it just tanks? It is a constant headache.
And you know what? That's the biggest problem with most trading. It all comes down to being right about the market's direction. But what if you could just sidestep that whole problem? What if there was a way to set up a position that could profit no matter what the market decides to do next?
Seriously, think about it. Anytime you buy a stock or a commodity, you're just betting it's going to go up. You short it, you're betting it's going to go down. It's basically a coin flip. And guessing wrong, well, that can hurt. This is where our strategy totally changes the game.
Okay, so how do we get around this whole prediction mess? Well, we use a clever strategy called Silver Arbitrage. And the whole point here is not to guess where the market is headed. Nope. Instead, it's all about finding a tiny existing price difference and just grabbing it. So you're probably wondering, what exactly is arbitrage? Well, at its core, it's super simple. It just means you're buying something in one place and selling the exact same thing in another place at the exact same time for a slightly different price. You literally don't care if the price crashes tomorrow or goes to the moon, because you've already locked in that little price gap that exists right now.
And the best part? The beauty of this whole thing is how simple it is. The entire setup is just 2 moves. That's it. And you do them at the exact same time. So let's break down exactly what those 2 moves are.
All right, here's the recipe. Step 1. You sell a silver futures contract. Now that's just an agreement to sell silver at a specific price down the road. Step 2. At the very same moment, you buy the exact same amount of silver, usually through an ETF, one of those stocks that just tracks the price of silver. Boom! By doing that, you've created this perfectly balanced position. One side is short, the other is long.
And this visual right here, it illustrates the concept perfectly. See the 2 sides of the trade? You're selling the future and you're buying the ETF. Think of it like a financial seesaw. If one side goes down in value, the other side goes up by pretty much the same amount. What's the result? A perfectly balanced, locked-in position from the moment you start.
Okay, is that still a little too abstract? No worries. Let's try an analogy. Imagine you promise to sell a brand new phone to your friend for 55,000 rupees. At the exact same time, you find a store selling that same phone for 50,000. So you buy it from the store, immediately sell it to your friend. Now, does it matter if the phone's price jumps to 60,000 tomorrow or drops to 40,000? Nope, not at all. Your 5,000 rupee profit is already in your pocket. It's guaranteed. That's arbitrage.
All right, now for the really fun part, the big question. Does this thing actually work no matter what happens? Let's put it to the test. We're going to run the numbers through 3 totally different market scenarios. A bullish market where prices go crazy high, a bearish one where they crash, and a neutral one where, well, nothing really happens.
Okay, first up, the bullish case. This is the dream scenario for anyone holding silver, right? Let's imagine the price of silver just rockets to the moon, hitting 4 lakh rupees per kilogram. So, what happens to our 2-sided trade?
Okay, now remember, we sold that futures contract. So since the price went way up, that position is now showing a pretty big loss. 70,000 rupees. Ouch! At first glance, that looks pretty bad.
But wait for it. This is where the magic happens. While that futures position was losing money, what was our other position doing? The silver ETF we bought? It was soaring right along with the market, racking up a huge profit of 1,25,000 rupees.
So, let's do the math. What's the final score? You take your massive 1,25,000 rupee gain, you subtract that 70,000 rupee loss, and what are you left with? A net profit of 55,000 rupees per kilogram. The loss was totally covered, with plenty to spare.
And this table, this right here, is the ultimate proof. Just look at that final column. Forget everything else for a second, and just look at the net profit. In the bearish case, when the price tanks, you make 55,000. In the bullish case we just walked through, you make 55,000. And what if the price does absolutely nothing, just stays flat? You still make 55,000. It just doesn't matter. The outcome was locked in from the very beginning.
Now, I know this might feel a little bit like magic, but it's not. It's just pure market mechanics. So, the really important question is,
Where does this consistent 55,000 rupees actually come from? Let's pinpoint the source of the profit.
It all comes down to one simple thing. It's called the spread, or sometimes the basis. And all that is the price difference between the futures contract and the ETF at the very moment you put on the trade. That little gap in price, that's your profit. The entire trade is just built to capture it.
Let's look back at the numbers from our example when we started. You sold the future at 3,30,000. At the same time, you bought the ETF at 2,75,000. See that? Right there, on day one, there was a price difference of 55,000 rupees. The whole strategy is just about holding on to that difference until the trade closes.
And that 55,000 rupees per kilogram, that's the prize. That's the spread you locked in the second you placed the trade. The rest of it is just waiting. Waiting for the futures contract to expire so you can collect the profit you've already secured, no matter how crazy the market gets in the meantime.
So, let's zoom out. What's the big picture here? Why does a strategy like this even matter? Why should it be on your radar as an investor? Let's wrap up with the key takeaways.
Okay, so what are the big advantages? First, it's market neutral. You're not betting on up or down, so you can sleep at night. Second, you have a defined profit. You know exactly what you stand to make from day one. And third, it's low risk. Because those two opposing positions act like a hedge, they protect you from those wild price swings. This makes it a great strategy for volatile or uncertain markets.
You know, if you remember only one thing from this whole breakdown, let it be this. With a trade like this, the profit isn't made when you get out. It's locked in the moment you get in. The rest is just the process of letting the market do its thing to deliver the result you already secured on day one.
And that kind of brings us to a final thought to leave you with. We've seen how this works beautifully for silver, right? By taking advantage of that little price gap between the futures price and the current price. So the question is, where else do these kinds of opportunities exist? What other assets out there could this exact same principle apply to? Well, that's something for you to think about. I really hope you found this breakdown helpful.